Good afternoon and welcome to our press conference. We are here with President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. We're also joined by journalists via remote connection. So when you take the floor, I would ask you to turn on your cameras and your microphones. And with that, I would like to hand over to President Lagarde. President Lagarde, please.
Thank you very much. Good afternoon. So the Vice President and I welcome you today to our press conference. The Governing Council today decided to lower the deposit facility rate, the rate through which we steer the monetary policy stance, by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to take another step in moderating the degree of monetary policy restriction. Recent inflation data have come in broadly as expected, and the latest ECB staff projections confirm the previous inflation outlook. Staff see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26, as in the June projections. Inflation is expected to rise again in the latter part of this year, partly because previous sharp falls in energy prices will drop out of the annual rates. Inflation should then decline towards our target over the second half of next year. For core inflation, the projections for 24 and 25 have been revised up slightly as services inflation has been higher than expected. At the same time, staff continue to expect a rapid decline in core inflation from 2.9% this year to 2.3% in 25 and 2% in 26. Domestic inflation remains high as wages are still rising at an elevated pace. However, labor cost pressures are moderating and profits are partially buffering the impact of higher wages on inflation. Financing conditions remain restrictive and economic activity is still subdued, reflecting weak private consumption and investment. Staff project that the economy will grow by 0.8% in 24, rising to 1.3% in 25 and 1.5% in 26. This is a slight downward revision compared with the June projections, mainly owing to weaker contribution from domestic demand over the next few quarters. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. As announced on March 13, 2024, some changes to the operational framework for implementing monetary policy will take effect from 18th of September. In particular, the spread between the interest rate on the main refinancing operations and the deposit facility rate will be set at 15 basis points. The spread between the rate on the marginal lending facility and the rate on the main refinancing operations will remain unchanged at 25 basis points. So I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning to the economic activity. The economy grew by 0.2% in the second quarter, after 0.3% in the first quarter, falling short of the latest staff projections. Growth stemmed mainly from net exports and government spending. Private domestic demand weakened as households consumed less, firms cut down business investment, and housing investment dropped. While services supported growth, industry and construction contributed negatively. According to survey indicators, the recovery is continuing to face some headwinds. We expect the recovery to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should also continue contributing to the recovery as global demand rises. The labor market remains resilient. The unemployment rate was broadly unchanged in July at 6.4%. At the same time, employment growth slowed to 0.2% in the second quarter, from 0.3% in the first. Recent survey indicators point to a further moderation in demand for labor, and the job vacancy rate has fallen closer to pre-pandemic levels. Fiscal and structural policies should be aimed at making the economy more productive and competitive, which would help to raise the potential growth and reduce price pressures in the medium term. Mario Draghi's report on the future of European competitiveness and Enrico Letta's report on empowering the single market stress the urgent need for reform and provide concrete proposals to make this happen. Implementing the EU's revised economic governance framework fully, transparently, and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Governments should now make a strong start in the direction of their medium-term plans for fiscal and structural policies. Looking at inflation now. According to Eurostat's flash estimate, annual inflation dropped to 2.2% in August from 2.6% in July. Energy prices fell at an annual rate of 3% after an increase of 1.2% in previous month. Food price inflation went up slightly to 2.4% in August. Goods inflation and services inflation moved in opposite directions. Goods inflation declined to 0.4% from 0.7% in July, while services inflation rose to 4.2% from 4%. Most measures of underlying inflation were broadly unchanged in July. Domestic inflation edged down only slightly to 4.4% from 4.5% in June, with strong price pressures coming especially from wages. Negotiated wage growth will remain high and volatile over the remainder of the year, given the significant role of one-off payments in some countries and the staggered nature of wage adjustments. At the same time, the overall growth in labor costs is moderating. The growth in compensation per employee fell further to 4.3% in the second quarter, the fourth consecutive decline, and ECB staff projected to slow markedly again next year. Despite weak productivity, unit labour costs grew less strongly in the second quarter, by 4.6% after 5.2% in the first quarter. Staff expect unit labour cost growth to continue declining over the projection horizon, owing to lower wage growth and a recovery in productivity. Finally, profits are continuing to partially offset the inflationary effects of higher labour costs. The disinflation process should be supported by receding labour cost pressures and the past monetary policy tightening gradually feeding through to consumer prices. Most measures of longer-term inflation expectations stand at around 2%, and the market-based measures have fallen closer to that level since our July meeting. Let's look at our risk assessment. The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could also be lower if the lagged effects of monetary policy tightening turn out stronger than expected. But growth could be higher if inflation comes down more quickly than expected and rising confidence and real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Inflation could turn out higher than anticipated if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Financial and monetary conditions. Market interest rates have declined markedly since our July meeting, mostly owing to weaker outlook for global growth and reduced concerns about inflation. 4.4 between June and July, and it is not satisfactory. It is resistant, it is persistent. This is the reason why we have to be resilient in our approach and very attentive to the various components of core inflation as measured by those various indicators. The third prism is the policy transmission. And on that front, we all observe that the financing conditions continue to be restrictive, and the footprint of our monetary policy in the real economy has been visible. So, on the basis of that review of incoming data, staff analysis, consistency of the projections for the fifth exercise in a row, that decision to cut by 25 basis points was perfectly legitimate and, as I said, unanimously decided. I drink to the future. Well, future, I'm tempted to quote, Spanish, que será, será, because we have consistently said, and we repeat again, that we shall remain data dependent, and that is particularly justified in view of the uncertainty that abounds. So we shall be data dependent. We shall decide meeting by meeting, and our path, of which the direction is pretty obvious, a declining path, is not predetermined, neither in terms of sequence nor in terms of volume. And I would like to add one thing which I have already said before, which is still true, which is that data dependency does not mean data point dependency. We're not going to be fixated on one single number. We are looking at a whole battery of indicators. And I'm saying that in particular because September will certainly deliver a low reading of inflation, very likely. We expect, because of the base effect, particularly on energy, our inflation numbers to be up in the fourth quarter, so the last 3 months of 24, but September is going to deliver a low reading. But we're not just looking at one indicator. We're looking at a whole range of data that we receive.
Thank you, Madame Lagarde. And the next question goes to Francesco Canetti of Reuters. Francesco, please.
Thank you very much. Good afternoon, everybody. The October meeting is a short 5 weeks away. So to use your own words from March, do you think you will know a lot more or just a little more come October 17th? Second question is about something else. It's about something that the ECB has been championing for years, and that is cross-border consolidation between banks. It seems it's finally happening, with UniCredit building up a stake in Commerzbank. So does the ECB welcome this development?
Thank you very much for your two questions. On your first questions, we can all count. It is 6 weeks before October 17th, which is a relatively short period of time compared to other intervals that we've had in the past. I would simply repeat what I have said. We are going to be data dependent. We are going to decide meeting by meeting. I'm not giving you any commitment of any kind as far as that particular date is concerned. And our path is not predetermined at all. On the other matter that you referred to, typically we do not comment on individual institutions, and as you know well, we have a clear procedure which involves our supervision authority, the SSM, which at certain thresholds of equity ownership or transfer of shares, if you will, has to be consulted, has to authorize. And of course, I'm confident that the authorities of these institutions concerned, namely UniCredit and Commerzbank, will be perfectly aware of their regulatory requirements and will comply with such requirements. The SSM will do what it has to do in full independence, and clearly cross-border mergers have been hoped for by many authorities, and it will be very interesting to see that process unfold in the weeks to come.
Thank you. And the next question goes to Mark Scheuers of Bloomberg. Mark, please.
Yes, thank you. The first one, you said again that the rates needs to be sufficiently restrictive for some time. How many times can the ECB cut interest rates before they are no longer sufficiently restrictive? So basically, where do you see the so-called neutral rate? And the second one is more the effect of interest rate cuts. How much of a boost could such cuts deliver to the euro area economy, given that at least some, if not most, of the problems are structural? Thank you.
Thank you for your two questions. I'm going to spend a bit more time on your second question, because on the first one, how long are we going to be sufficiently restrictive until we have been sufficiently restrictive? Because what we want is to achieve the goal of returning inflation to target in a timely manner. As I said, for the fifth projection exercise, we have inflation at target during the second half of 2025, and that is on the basis of the baseline that we have in our projection. And we're going to observe how that baseline evolves over the course of time as data comes in to decide for how long we have to continue cutting rates and at what point we have been sufficiently restrictive. So I'm not going to give you any idea as to where our star is, because this is an unobservable concept anyway, and we will, as we get closer to it, we will know certainly better. As you probably know, staff has produced a very good paper on our star, which indicates that it's probably a tad higher than where it used to be. But, I'm not endorsing this. I think, as I said, as we get closer to it, we will know better whether we are there. And there are multiple factors that are going to impact on that. Now, your second question, is this 25 basis point cuts going to be a boost for our economy, given that so much is structural? So, I know I'm preaching the converted here, but obviously there is a lag between the time when we make a decision and the impact is actually felt and can be observed in the economy. What we are still observing at the moment is the impact of our tightening decisions from more than a year ago, almost 2 years ago now. This continues to have an impact. We believe that the peak has been reached in relation to GDP, but there will be continued, although downward sloping, effects of those decisions, and we will have the same kind of lag applying to the decision that we are making now. So that's point number one. The passing of time does not satisfy the instantaneous satisfaction that we would have to see the results coming out of our decisions. This is the reality of monetary policy and the functioning of our economies. The second part of my answer to your question, because you do refer to structural causes, gives me a chance to actually commend the Draghi report. We haven't had time to dissect everything, neither has anyone for that matter, because it's sufficiently substantive and material enough to require more time and special attention. But it's a formidable report in that it poses a diagnosis which is severe, but which is just, in our view. And it also points to structural reforms, practical proposals to achieve such structural reforms that could be extremely helpful for Europe to be stronger, but also for us as central bank to achieve better results in our monetary policy. If productivity can rise as a result of the structural reforms, for instance, that would be very good news for us. If the capital market union can be implemented and more financing be made available available in order to finance innovation. That is good news for us as well when it comes to inflation, price stability, and the components that underlie this work that we do.
Thank you, Madame Lagarde. And the next question goes to Aude Kersulek of BFM TV. Aude, please.
Thank you for having my question, Madame Lagarde. Are you worried about the risk of below target inflation? In France, INSEE estimates that inflation will be 1.6% in December, and we can add that oil prices are the lowest since COVID, so is it a risk? And second question about the Mario Draghi's report. Can it have an impact on monetary policies on the ECB's mandates? Thank you.
As you will appreciate, I'm not going to give you an answer that is country-specific because we work on a euro area basis. But obviously it's a risk that we have to be attentive to, which is why we are targeting that 2% sustainably. Has to be asymmetric in the medium term, as we have anticipated in our strategy review, which remains completely valid. You mentioned two things. You mentioned one thing in particular. You mentioned energy. Well, energy has been one of the key factors that took prices up, directly and indirectly through all sorts of channels. And in the same vein as it took prices up, it is helping to move prices down. Well, this is an exogenous matter, and this is one, that can move again, and that we have to be prepared for. The second question you ask is, and I think I have partially responded to your question. Some of the proposals in the Draghi report, as well as in the Letta report, by the way, because achieving the single market and improving the competitiveness in our view can be very complementary. But some of those proposals touch directly on what we are specifically concerned about. And the Capital Market Union is one in particular on which the Governing Council has had a strong view and issued a special opinion upon. In the same vein, the financing of innovation, the increase of productivity, the competitiveness in relation to its external position, all of that actually matters when it comes to the work that we have to do. I didn't see in Mario Draghi's report any suggestion that the mandate of the ECB should be modified. We have a single mandate, as you know, which is price stability. We comply with the treaty and with the mandate that was given by the founding fathers of Europe. And hopefully we can, not hopefully, but we will deliver on that mandate. And whatever is suggested by Mario Draghi has a lot more to do with structural reforms. And I very much hope that the executive authorities in charge will actually take it to heart and will see a path towards those structural reforms.
Thank you. Turning to the remote participants, I'd like to give the floor to Martin Arnold of the Financial Times. Martin, please.
So Martin is still with us?
Today.
Ah.
Anyway, hello, President Lagarde. Two questions from me, if I may. Firstly, I'd like to ask about services inflation, which the latest reading showed went up again. How much concern does that give you? And what do you see as the risks going forward on that, as you've raised your forecast slightly for core inflation? And the second question, if I may, is back on the Draghi report. Does the ECB intend to adjust monetary policy in any way to facilitate implementation of Draghi's proposals? Thank you very much.
Well, thank you so much for your two questions, and thank you for pointing to this services inflation, because that is clearly the component of prices that requires very attentive understanding, monitoring, and I'll come to that in a second. But suffice to say that it went up from 4.2 to 4.4. So whereas so many other components are on a declining path, that particular segment is increasing. And we've tried to decompose what is behind it. And it's a combination of holiday packages, insurance, and I'm trying to remember what is the third one. I'll come back I'm sure it will come back, but it's predominantly these two. We are looking attentively to the nexus of three elements. Number one, wages. Number two, profits. Number three, productivity. And services is particularly sensitive to wage increases. So our expectations is that services inflation will decline over the course of 25. Why? Because what staff had anticipated, which is moderation of wages growth, buffering of wages cost by slightly declining profit, and increase of productivity is actually being demonstrated by numbers, by observations. If you look at wages, whether you look at compensation per employee, whether you look at negotiated wages, whether you look at unit labor cost, all of that is going down. Wage tracker, same thing. And our expectations is that it will continue to go down in the course of 25. We will, on negotiated wages, we will still have relatively high numbers, and we know that some are in the making at the moment. The auto workers unions, the IG Metall request, and in various other countries, but with some heterogeneity, will continue to move wages higher in the first half of 25, but then it's definitely on a decline path. It is already the growth is on a declining path, but it will pick up again in the latter part of 24, very early in 25, and then it will continue to decline. And the numbers that we have for growth in wages, I will share with you. I've got my unit profit growth. So I'll give you the number later if you're interested, but it is definitely declining. That's on the wages. On profit, we are now observing from high numbers that we had at the end of 20 up until the end of 23. We are seeing declining numbers on profits, and as a result of that, you can obviously deduct that profits are actually buffering and absorbing some of these labor cost increases. On productivity, it is also on a declining path, moderate and not it's on an increasing path as considered and envisaged by staff, a little less than what they had projected, but it's also heading in the right direction. So that really confirms the views that they had taken initially, and that has given us confidence that services will move downward as well, that wages growing moderately and more moderately now, profit absorbing more wages, and productivity increasing a little bit by virtue of, cyclicality, will lead us to having services prices less than where they are at the moment. But it's obviously a sector that is, as I said, which is resistant and on which we have to be very attentive. You had a second question, if I remember, and I'm trying to... Oh, yeah. Mario Draghi's report includes so many important structural reforms that are going to be the responsibility of governments, that will require the leadership of the Commission and the leadership of those leaders in Europe who are determined to strengthen Europe, to give it more sovereignty, to give it more capacity in the current geopolitical circumstances. That I'm really certain that monetary policy will do what it has to do, which is to provide price stability and to deliver on its mandate, while structural reforms are not the responsibility of a central bank. They are the responsibility of the governments.
Thank you, Madame Lagarde. And staying with the remote participants, I'd like to give the floor to Silvia Berzoni of the Italian TV channel Class CNBC. Silvia, please.
Thank you very much, Wolfgang. So good afternoon, President and Vice President.
Good afternoon.
I will have two questions, if I may. The first one is, were you expecting such a slowdown in German economy? And how does it factor in your projections and balancing of risks? And the second one, I would like to go back on Unicredit Commerzbank. So in compliance with all the prudential requirements and buffer, do you believe that the emergence of a pan-European bank could be a positive for the industry as a whole and Eurozone? Thank you very much.
Our staff provides projections, goes into real in-depth analysis of the situation of every country, and receives the feedback of the National Central Bank. So they don't provide projections, or they don't provide analysis in the vacuum of the wonderful main building and Euro Tower of the ECB. We do reach out, we do work together on a Euro system basis. And the slowdown of the German economy was certainly anticipated by the Bundesbank, certainly the ECB as well, and shared on a Euro system basis. So it's embedded and included in the projection that we have, and we analyze that very carefully with members of the Governing Council in the last couple of days, because there is clearly heterogeneity amongst various countries. When you look at countries separately as they come together to form the system, you see, for instance, that at the moment, Spain or the Netherlands are delivering strong GDP numbers, while at the other end, Germany is on the other side. Your other question about pan-European banks. I think there are quite a few pan-European banks. What you're talking about here is more a cross-border merger between two large national institutions. And that is something which, as I said, will be reviewed from a regulatory standpoint, and which certainly will satisfy many of those who have expected cross-border mergers to result from, banking union when it is achieved. So,
thank you. And the next question goes to Christian Siebenbiedel of Frankfurt Allgemeine Zeitung. Christian, please.
Yes, thank you very much. You emphasized that one part of the decision with the deposit rate was anonymous. Were there other parts of the decision that weren't anonymous?
What part of the decision? You know, we had extensive discussions on all the data that we received, all the analysis that was produced by staff. And, you know, we tested the rationale behind the current recovery, which is moderate, and the pickup in recovery that we expect in 25 and 26. And I think we were convinced that while consumption is low and has actually weakened, it should economically result from the combination of higher net income, fading monetary policy impact, and low inflation. It should necessarily result from those forces that consumption and investment actually pick up. So we tested all that, and we discussed, and you know, some tend to be a bit more pessimistic, some are more optimistic, but we really discussed in depth the rationale behind those outlook numbers that we have for 24, for 25, for 26. And the reason why we revised by 0.1% only, is really a combination of reduced net export numbers, given the uncertainty and the geopolitical risk that we have going forward, and a carryover of the situation that we have now, which is reduced activity because consumption has been lower than we had anticipated. But as I said, we are going to assess each and every time along the way all the data that come in and see that we continue to reach our target in a timely manner.
Thank you. And the last question today goes to Andres Stumpf of Expansion. Andres, please.
Thank you, Madame Lagarde. I have two questions. I have one about the projections. On the one hand, we have no changes in the inflation side, but on the other hand, we have our revision in growth outlook caused by a weaker internal demand, which is the main contributor to inflation. How does this add up? And the other question is, I saw you welcome Mr. Escrivá, the new governor of Banco España, and I was wondering if you could tell us your first impressions and what do you expect from his contribution to the governing council. Thank you.
Thank you very much for your two questions. So you are correct that our projection numbers for HICP, which is the headline inflation, have not changed a bit. They are the same as in June. We haven't revised. The one that we have slightly revised is core inflation. We have revised core, which takes out energy and food by 0.1%. Well, we have revised 24-25. We have not revised 24-26. And that is caused by what? By the fact that energy prices have significantly impacted downward and have benefited to the headline inflation. The fact that food has slightly increased, but very little. And as a result of these two components, there's a bit of a trade-off and a net-off, if you will, with other prices, notably services. Now, we have revised downwards the outlook for growth because the consumption that we had anticipated for now, essentially, because net income, as begun to increase. Inflation has gone down significantly, and we were expecting consumption to pick up, has not picked up. And I think that we will be looking at that carefully when we produce our next growth and GDP numbers. José Luis Escrivá has joined the circle of the governors, and we have greeted him, we have welcomed him in the circle of governors. Like other governors, he has made some very useful contributions, and I hope, like any other governor, he will continue to not only give his personal views, and which might be inspired in part by the Spanish situation, but he will have this European dimension that other governors also have when they sit around the table of the Governing Council. And it is a process, and it's a journey that I hope will be productive and pleasant, both for him and for the group of governors around the table. But I can assure you that he was welcome, and he was contributing.
Thank you. That concludes our press conference. Thank you very much for participating. The next press conference will be on 17th of October, and that will be the external Governing Council press conference, which will take place in Ljubljana in Slovenia.
Yeah.
Thank you very much.